Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. ASML is one of the most important companies in the world that almost nobody has ever heard of. Now, if you follow the semiconductor industry, you know all about ASML because it is, again, one of the most important companies in the world. Now, it just reported earnings, and we've got three things that are standing out from its earnings report that we really want to highlight. I'm Jason Hall. This is The Smattering. I've got Jeff Santoro here with me to talk about those three things. Hey, Jeff.
Hey, Jason. Yeah, so ASML is one of my favorite companies, and I love it because it's a monopoly. It is the only company in the world that does exactly what it does, making the machines that you need to make the super high-end bleeding edge technology chips. And there was some news stories when they reported earnings recently about the slowdown in the economy and the cyclicality of the chip industry impacting ASML. But there was one particular metric that I think tells us that we don't have too much to worry about, at least in the short term, and that's their backlog. So they have enough backlog right now to basically get through the end of this year. Even if we see a massive slowdown, they're still going to be able to do what they do and sell their machines. So here's a quote from the earnings call. We've experienced several quarters of very strong bookings, which now provides backlog coverage significantly beyond 2023, which is almost twice the expected 2023 system sales. So they have way more desire for their machines and they have the capacity to build them right now. And that's going to help insulate them, at least in the next year or so, if we do see any further slowdown in the economy or in the chip industry itself.
So the second thing for me is kind of ties into that first thing. Even with that strong backlog, and again, they, like you said, they could not sign another deal and they would still meet their full year revenue right before they ran out of machines to sell and to manufacture. They're not off to the races expanding their manufacturing capacity by some large amount. They continue to be really conservative with managing their balance sheet because they realize that there's going to be a cadence of how that demand comes through. And there will be a slowdown in orders at some point, and they don't want to build excess capacity that they don't need. So that's the second thing for me. They're being really smart about how they're managing their balance sheet for when the eventual turn in the cycle starts to affect demand for orders a little bit for them. Jeff, the third thing for me is really, you talked about how this is basically a monopoly. Yeah, there's other companies that make lithography equipment, but that bleeding edge, the most advanced chips, yeah, they are the only player the only name in town, the only game in town. There's no doubt about that. But they're not resting on their laurels as much as they could. Again, you talked about that backlog. They could sit back and just wring out every dollar of profitability from that extreme UV lithography machines as they wanted to. But they continue to spend a ton of money on research and development because they know they got to where they are by continually focusing on what do we need to be bringing to the market 5 years from now. And they spent about 15% of revenue on R&D in the quarter, which you see periods where it's a little bit higher and a little bit lower, but you look over the long term, and that's roughly in the range of where they invest on their R&D. And I think that's a really great sign long term for investors that they continue to focus on not just being highly profitable, again, 50% gross margins for an equipment manufacturer, a 1 year backlog where they could not sell another machine and they could hit their full year revenue guidance. They're really focused on making sure that they remain as relevant and necessary 5 years from now as they are today.